We will now be moving on to the second panel of the morning, titled Fueling Change, Building Impact Ecosystems for Capital Mobilization. This session will explore the critical role of impact ecosystems in mobilizing capital to drive sustainable development. Experts will share strategies to align financial resources with social and environmental goals, ensuring transformative outcomes. I would like to invite upon the dais our panel, starting with our moderator, Ms. Mariel Rotondaro, Finance Director, South Latin America, Unilever. Our panelists for the day are Ms. Ranjna Khanna, Senior Director Programs, India Impact Investors Council. Mr. Anil Sinha, Senior Advisor, International Finance Corporation. Welcome. And we will be joined virtually by Ms. Carolina Suarez, CEO, Latimpacto. Ms. Carolina Suarez, CEO, Latimpacto, will be joining us virtually. I will now allow our moderator to take over. Thank you.
Here it is. Well, hi everybody. It's good to see you all here. Really, I wanted to thank ECOS, in head of Virginia and Jesse, for inviting me to moderate this panel of experts that I have here. And well, what we would like is to talk in the next 40 minutes about the role of impact ecosystems in mobilizing capital to drive sustainable development. So, to make it short, we will jump to this topic, and we will have an overview of impact investment, considering how much capital is being invested, what are the characteristics and the origin of this investment and investors itself, and which are the main sectors of impact. So in order to start, or I would like to start with Anil, talking about global trends, to then jump there with Ranjna, and we will then have a small video sent by Carolina that she's in Colombia, 11 hours behind us, so she sent her words to all of us. So we can start, Anil.
Firstly, thank you very much for inviting me. I'll be speaking on my personal behalf. I retired from IFC. I spent time with the Global Impact Investors Network, with the World Bank, but this is a summation of my experience and my personal take on this issue. On the first, in terms of the numbers, I'll draw from the report that the Global Impact Investors Network published last year. As you know, that's probably the leading organization in terms of impact investing, and their whole objective is to grow the impact investing network across the globe. So they did a survey of about nearly 2,000 organizations to get an idea about what is the total investing size. The number is 1.57 trillion, according to the Global Impact Investors Network, invested in impact assets under management. Let me clarify, $1.57 trillion AUM. The growth rate from the last time they did that, the last 5-year growth rate has been fairly impressive. The CAGR is 21%, which is pretty outstanding. And so the impact investing movement is gathering shape. If I go back to my IFC days, I joined IFC in '92, the financial institutions basically were saying, as their principle of operation, thou shalt not. In other words, we were told, don't invest in alcohol, don't invest in firearms. It was thou shalt not. The next step was do no harm. So environmental safeguards, social safeguards, good governance, and as you know, IFC's sustainable framework is perhaps the gold standard for investing. The next step in that continuation of doing no harm is to do good and do good intentionally. That intentionality in financing is basically what I think is impact investing. So the intentionality has to be to solve an environment or social problem, define it up front, and have a business solution to it. Impact investing necessitates a return. What return depends on the investor and their own objectives, and also measurement. These three go together. You asked the question about where is this spread. The Western Hemisphere really is where the funding comes, where most of the funding goes. The underserved regions, South Asia, Africa, are extremely underserved and underfunded. It's still less than 10%. So here is the conundrum. How do we increase impact investing in the areas that need it most? What's been driving this impact investing growth? And that's the other question you asked. Interestingly, it's a demand. It's a demand from investors saying they want their money to do good. Many big venture funds have set up impact investing funds to address that market demand. Secondly, the ability to combine financial and impact decision making. I think that's a very positive trend. People are asking, define the impact upfront before you bring us a financing proposal. So that ability to do that has been a positive thing. Thirdly, good human resources have come in. Venture capitalists are becoming impact fund managers, bringing professionalism into this space, which is extremely important, because without good impact fund managers, you won't be able to really have an impact fund market. So I think these three, and I can go into other trends too, but challenges still remain. The biggest challenge still remains is universal acceptance of impact measurement methodologies. GIN, the Global Impact Investors Network, has its own methodology called IRIS, and I think most of the impact funds are using that, but there's so many others. And Ranjna can talk about the study that IIC did about this, and that remains still an issue. When you define impact, we've come a long way to go. We were just discussing that. I think that remains a big issue still in terms of impact investing. The other trend really has been that the funding thus far into India has in the past largely come from foreign investors, but that's changing. You have domestic investment coming into impact investing. And I think that trend is a positive trend. I'll go into challenges a bit later, but let me just stop there as an overview. Thank you.
Thank you. Thank you. Please.
Yeah, thank you. Thanks for having me here today. I would like to thank Virginia and Jessica both. Our association go a long way. Last 7 years, so we've been in touch, and this is a great opportunity to connect these two organizations who've been working in our respective countries and doing similar type of work. So I represent Impact Investors Council today. So we are basically an industry body to build the ecosystem around impact investing in India. We've been now operational for the last 10 years, and we work in 4 key areas. Basically, we have research around the key impact investing trends in the country. Basically, we track the investment activity on a month-on-month basis of what is happening in India. We also do policy work in terms of explaining, going deeper into regulations. We build programs to increase the footprint of impact investing in India, and we build partnerships like across the globe. Coming to the impact investing, how it is doing in India, some quick numbers. Last 14 years during, I would say 2010, that is when we started tracking it in India, to 2024, we've seen funds to the tune of $40 billion go into impact enterprises. And this is deployment. This is not the fund size. This is deployment into social enterprises. Starting with 2010, when the yearly quantum was something like $300 million, to coming to 2024, when we actually saw $5 billion of investments go in a single year. So it is again a huge growth over the years, peaking at around $6.5 billion in 22 during COVID. That was the biggest investment year for us. Again, I think globally, like Mr. Sinha said, impact investments are growing at the rate of 20%, 21%. Likewise, in India, we are also growing at a CAGR of 20% in terms of investments. If we quickly look at it, I think the first 5 years actually defined impact investing more in terms of financial inclusion-based, focused investing in India. And very much sectoral focus around financial inclusion. It was the flag bearer of Indian impact investing. The next 5 years, I would say, actually saw it branch out in different sectors like agriculture, education, healthcare. These are some of the other sectors which emerged in the next 5 years, and we saw a lot of investments go into those sectors. Last 5 years, it has largely been technology. Technology into climate tech, technology into different sectors. Financial inclusion still continues to be one of our biggest sectors, but climate tech has emerged as our single largest sector which is attracting investments, because climate is at the intersection of so many other sectors. So I can say that climate plus agri, climate plus health, all put together, this is the biggest sector. So that is a quick lay of the land, and I think we'll dive deeper into the subsequent questions.
Okay, but what we can do now is to play the words and the videos sent by Carolina in order to have also the view of Latin America.
So let's focus on Latin America, and allow me to share an overview of impact investment in this region. According to the Global Impact Investment Network, GIBEF, the 24 State of Market report, impact investments in Latin America account for around only 5% of the global impact assets under management. It is an amazing and remarkable $14.5 billion US. This significant figure highlights the region's growth potential and importance in the impact investment landscape. While it's an encouraging figure, nearly 70% of impact investments remain concentrated in developed markets, such as North America and Europe. This underscores the urgent need to continue fostering impact investment in emerging regions like Latin America and South Asia, where such investments can drive meaningful social, economic, and environmental progress. Over the past 5 years, impact investments in Latin America and South Asia have experienced an annual growth rate of 11% and 9% respectively. Investors concentrated on emerging markets, 60%, and small investors, 50%, are making impactful allocations in Latin America, highlighting the region's potential for growth and opportunities. The data collected in 2023 from the ANSPEN network of development entrepreneurs Anil reveals a significant correlation between the location of an organization's headquarters and the sources of resources available to it. This finding highlights the critical role that geographical context plays in shaping an organization's access to funding, partnerships, and support networks. The implications of this insight are both compelling and noteworthy, as they suggest that the strategic choice of headquarters could have a substantial impact on an organization's overall success and sustainability in the competitive landscape of developing entrepreneurship. For instance, organizations based in Latin America tend to raise capital within the region, meaning Brazil, Mexico, or Colombia. In contrast, those based outside Latin America raise capital most frequently in North America, Europe, and Central Asia. And this same report reveals that the main sectors of impact investments in the region are agriculture and food, 67%, education, 54%, health, 44%, financial services, 46%, conservation of biodiversity and ecosystem, 44%, and energy, 43%. This information matches GIN's 2024 findings on global assets allocation by sector.
Good. Well, I think it's very clear in terms of what it has been said about how this capital, more than being mobilizing, I would say that it's concentrated in development countries. So there is much to do, of course. And in that sense, my second question is about how players in the impact ecosystem are being connected. And in that way, how is this capital being mobilized towards sustainable development? But we can also add this thing of how it's going to emerging countries that you've said they need the most. So Anil, I would like you to talk a little bit about it with your experience in IFC and different institutions. How do you see the articulation of these ecosystems, and what are the main challenges in connecting investors with high impact projects in these emerging markets?
So where is this source of funding coming from? Fund managers, pension funds who have huge checks to write. They can't write small checks. Absorption of those big checks is still not clear to them, or it's not established. That where will the money actually go? Will it be absorbed? Private wealth funds. It's interesting to see in India, like I was saying, I was talking to my friend Vineet Rai, Avishkar, who's perhaps one of the leading fund managers in India. He says the first fund, 99% foreign funded. Last fund, nearly 50-50, local funding. That tendency has to increase. You have to have your own funding in your own country being mobilized along with foreign capital to go in the areas that you want it to go. The good part of the ecosystem is there's a number of initiatives already under play. Firstly, I think the startup ecosystem in India has never been so good. So you have entrepreneurs coming through. Many of them are looking for social programs, social projects to set up. So you have a demand coming through for that funding. The Fund managers also, I think that the capacity of the fund managers has increased tremendously also, and you need to develop on that. And you need to really get the government on the table with you. What we did in one of my other programs was to set up a multi-stakeholder platform where you had the government, you had the private sector, you had the financial institutions, and the entrepreneurs sitting across saying, this is the problem we want to solve, and how do we solve it in terms of execution and in terms of funding. In many of these areas, it's the poorest of the poor that are affected. And I think you can't leave the government out of this in terms of the ecosystem. No matter how much money private sector brings in, it's a drop in the ocean compared to the funding that the government has at its play. How well it is mobilized, where it is mobilized, is another issue. And increasingly we are seeing new initiatives coming through from the government. I mean, apart from the AI structures, also the sandbox, trying new policies, etc., are coming through. So one is to have that multi-stakeholder platform working together at the highest level. And I think that's one way to address the ecosystem development as a whole. And hearing of the challenges from all these stakeholders. What is preventing the financial institutions from getting involved? What is preventing other solutions coming into play? And I think that is one way to do that. And I think I did that in one of my other programs regarding agribusiness, which is a new sector that's come through for impact investing. And in the agribusiness sector, we had the government and the private sector sitting down together and discussing what the problems are in the entire agri value chain and who can do what to solve that problem and how we can do it jointly. So did that in the water program. Both areas, you can't ignore each other. You can't ignore the technology that private sector brings in. You can't ignore the entrepreneurship ability, the business mindset that comes in with the private sector. But you can't ignore the government also at the same time. So in both programs, very successful going forward. Could we think of something around this in the impact investing space as more of a formal space than what we have now? That's one area to look at. The other is influence of the financial institutions. So for example, if I take IFC, they have their own sustainability principles. Anybody who borrows money from IFC, whether it's a fund or an entrepreneur or a corporate, has to follow those principles. In terms of impact investing, they have their own principles, IFC called OPIM, Operation Principles for Impact Measurement, where they have a voluntary group of financial institutions that buy into this. So one is the influence that the financial institutions can bring, and the other is the stick that the money can bring. That is a very powerful force for good. And I think that's an area where the financial institutions can be more educated, but all of them will come back and say, you talk about impact investing, how do we measure it? So get together, and can we arrive at some common framework that we can all agree upon? And it could be a mix, it could be one, it could be the other. I'm not, even though I know the IRIS program well, being in IFC and being in GIN, but I'm not fixated by that. But I think there's a need for that. Otherwise, you don't have impact investing as a entity going forward. I think I'll stop there and come back later and hand over to Ranjna.
Interesting what you were saying about the need of the private funds, but not to set aside government that in the end also establish the rules, no, for everybody. So, well, Ranjna, I wanted to ask you about the role, the mechanisms in terms of innovation finance, blended finance and impact of bonds, how they are playing in mobilizing capital for sustainable development. And then we will also have the view recorded by Carolina from Latin America. But let's start with you, and if there are some examples, good examples, success examples also to bring.
Thanks, Mariel. So blended finance, I think in very simple words, is nothing but a blend of different kinds of capital, basically. As we all know that in the sustainable development of any country, or I think simply put in any impact continuum, there is a different role which different kind of capitals can play. Nothing to underscore the importance of one type of capital or to emphasize the importance of the other. On one hand of the spectrum, you have very high impact sectors, but maybe the risk is also higher. There are no returns for the first few years. So this is one end where your philanthropic or catalytic capital or your governmental funds, they have to play a larger role because the sectors are high impact and a much needed developmental expenditure should go in those sectors. And on the other hand of the spectrum, you have sectors where the returns are higher, the impact is lower than probably the high impact sectors, but the impact is there. But yes, the returns are also there. So these are typically the sectors or the places where your commercial capital plays a role, your VCP kind of funds, they play a larger role there. Now, what blended finance can actually achieve is, getting a combination of these two together so that initial phases you can de-risk your high impact sectors with the help of catalytic capital so that it becomes more amenable or more attractive for the commercial investors to come in. So that is, very simply put, that is what blended finance means. There are different kind of structures which exist within blended finance. Speaking largely from Indian context, we see it's not one-stop solution for everything, but I would say it has the capability of bringing different type of capitals together. So that is the larger role. Some successful examples, what we've seen it work very beautifully is in the education sector. There are certain outcome-based impact bonds launched here which worked really well. Educate Girls was the first impact bonds where, the payments were linked to the outcomes of, achieving higher girl retention in certain rural areas within India, and it was achieved very beautifully. So 3 years continuously, the performance of the bond was measured and it worked very beautifully. Something similar, Quality Education India bond also worked very well, where education outcomes of, was linked to like learning outcomes, that if certain learning interventions were introduced in certain government schools across certain areas, how are the learning outcomes getting improved at the student level? And the payments ultimately by the outcome funder were linked to the outcomes getting achieved. So if this level of the outcomes are achieved, then this level of return you will get, and so on and so forth. So these kind of models have worked beautifully, but still I would say that the level of complexity in these kind of transactions, like the impact bonds, DIBs, these are very sophisticated instruments. Not to say that, I mean they are complex also, but so that it needs a certain type of ecosystem to work together. It needs agreement over certain metrics. It needs a performance evaluator. It needs, a watertight contract to put all of this together. And that is why it takes so much of time to put together these impact bonds and all. But some of the other structures work equally beautifully as well. We have seen so many of credit enhancement structures like guarantee structures given by multilateral organizations like USAID in the past, and some other organizations as well, who are happy to, give a guarantee of a first loss or so that the other, lending organization can lend to the weaker sections. So for some time, till the time, their financial condition improves and they come out of that thing. So such kind of structures work very, very beautifully. And I think they play a very big role in terms of de-risking high-risk sectors. So I think I'll take a pause here.
I could just give a, well said, Ranjna. I just want to give a global view to this in terms of blended finance. According to Convergence, which is a think tank that works on the impact investing space, the total market for blended finance thus far has been about $230 billion. IFC is a big player in the blended finance sector. We put in 5.9 billion and leveraged 32.6 billion in commercial money from that. So you can work out what the leverage can be in terms of bringing in capital. Examples are hydro projects in Nepal, etc. So that's the sense, the global sense. Yeah.
Yes, for sure. We can listen to Carolina now. Of course. Thank you.
So let's bring some success stories for Latin America, where you can find several innovative finance structures that have already demonstrated success in Latin America. First, the Colombian Social Impact Bond for Education. It was launched in 2016, provided upfront private investments to improve educational outcomes for vulnerable students. The initiative led to increased school attendance and better academic performance. The second one, the Latin American Conservation Fund, employed blended finance to support biodiversity conservation and sustainable land management in Brazil, Colombia, and Peru, attracting both concessional financing and private capital. And the third one that I want to mention is the Mesoamerican Reef Fund, MAR Fund. It leveraged blended finance to protect one of the world's largest coral reef systems while promoting sustainable tourism and community livelihoods. These are only two examples that showcase the potential for impact investments to drive meaningful change while offering financial returns. But how to ensure these financial models benefit local communities and contexts? We need to highlight that we need collaboration with local stakeholders. Impact investing must be designed with and for communities, leveraging insights from local organizations, governments, and networks like Latimpacto to address fundamental challenges and opportunities. Second, flexibility without losing rigor. Why? We need to understand that each country has its own economic and social landscape, but we must align with global impact measurement standards to ensure transparency, scalability, and comparability. And third, innovation and adaptation. We must develop financial instruments that balance risk and return, incorporating blended finance models and results-based financial structures.
Well, good. Really, there is no doubt about the need of finance as a key player to drive the ecosystems and to bring sustainability alive. And there were some words said here. Carolina talked about rigor. Also, you talk about large numbers, large figures of these investments. So now, Ranjna, I wanted to ask you, what are the key challenges in impact measurement? That was something that also have been said during all our talk.
Absolutely, and I think impact measurement is actually a key for increasing the credibility of the entire impact process. But it's saying that is very easy. What we've also conducted a study to evaluate that, what are the key challenges in the Indian ecosystem, faced by enterprises, funds, and why are we not seeing more and more impact reports getting generated? While I would say that Indian ecosystem has evolved significantly from the time we started in terms of measuring impact, of their operations, but there are still challenges, I would say at the enterprise level, let me start with something like, very basic, the cost, cost of collecting data, which is not incidental to your business model, is an extra burden on the enterprise. Now you're talking about an enterprise which is early stage, which is solving a social problem. The business model is very clear in the mind of the entrepreneur because that's, is internalized in his, DNA and all. But defining an impact hypothesis, defining an impact process might not come very intuitive to the organization, especially in the early years. So that, to us, I think is one of the big hurdle, cost of, getting all that systems, processes. Second is that most of these impact measurement processes are defined at the topmost level, at the asset owner level, LP level. Now, think about an enterprise which has been invested by, say, multiple investors. So you can imagine that there could be data requirements as per different investors, and these data might not talk to each other. So that adds to the level of complexity because the requirement of data is not aligned at the topmost level. There is lack of standardized metrics in India. I would say still, but over the years we've seen people converge or funds converge over 2-3 major practices across the world, which we also follow. IMP, Impact Management Program. We see sustainable development goals, reporting according to that Indian government also gives importance to. And of course, IRIS and IRIS Plus by GI, Global Impact Investing Network. So these are some of the frameworks around which we see most of the evaluations getting done these days. But still, I would say that there could still be more convergence around standardized metrics for specific sectors, because every organization, when they define their objective, they define their own goals according to their own, objectives. And there are no standardized metrics for, say, particular sectors and all. If we say agriculture now, 3 companies within agriculture might be recording their impact because they are catering to a different segment altogether, and they might be recording it in a totally different way. So it becomes very difficult to aggregate, it becomes very difficult to standardize also. So yeah, these are some of the top of my mind challenges. There are enough and more, but I think I'll take a pause here and yeah.
So I think this is an important issue. Where should be going to? I mean, for example, if you give a financial statement and it's audited by X company, that is something that you can take and believe. You can't do that if you're giving an impact statement, because there isn't that credibility still. And I think to do that, standardization in terms of measurement and standardization in terms of even people who can verify is important as we develop the ecosystem. Yeah. I think that's an area to play at. In terms of the entrepreneur, I fully agree with Ranjna. You cannot burden the entrepreneur with too much. We should make a difference between data collection, when the entrepreneur can collect data at the grassroots level better than anyone else, and evaluation of impact. That's not his job or her job. That if you want to do that, you do that separately. You have your own metrics for that. You have to make it user-friendly. What IRIS Plus tried to do was to look at each sector, look at a number of metrics that are common, and so that you can pick, if you're an agri business, some metrics which are common, and people can report against those. Plus there are additional ones you can do, but those are mandatory ones that you can compare. Right now, you cannot make a statement as to what is the impact across, because there are no common statements that you can add up. And unless you can tell that story to the external world, you don't have a credible story. So that's where we should get into in terms of, I think, the ecosystem. That's what's missing, and I think there's a big play in that by leading financial institutions and leading investors to set this framework right.
Well, thank you. We have only a few minutes, but what we can do is to, I don't know if you want to talk about local collaboration and global collaboration, and we finish with that one. Really a pleasure to be talking with both of you.
About 15 years ago, I wrote a paper called Corridors of Prosperity between India and Africa. How Indian business solutions can go to Africa and what would make them be acceptable and established in Africa. Could we be looking at a Corridors of Prosperity or any other name, a pathway to be established between India and Latin America? And what would that take in terms of information? We can look at social entrepreneur solutions, we can look at common solutions. I know the social fabric is different, but there are still common development problems in both countries. What are the impact investing solutions to those problems? Can we compare? Can we exchange? Can we learn? And can we cross-fertilize?
Good. Well, really, it's my pleasure to be moderating this panel. Finance is absolutely critical in order to lead all this impact that the force for good, I would say. And there are many challenges. There is money, there are funds, but we need them to capture in our countries, so that is all a challenge. We need to measure it, because we need not only to be compared, but also for our stakeholders, in order them to know where they are, investing. And we need also to be responsible with the local ecosystems, something that was mentioned by Carolina and now in the end by Anil. So really, I think it was an excellent panel. Thank you both.
I would like to thank our moderator, Ms. Mariel Rotondaro, and our esteemed panelists for their very engaging discussion on strategies to align financial resources with social and environmental goals, key challenges in impact measurement, and collaborations.